Sonal, great to catch up with you. Walk me through why you still believe that we could face further hawkish surprises.
So I think the surprises stop being surprises as the market starts expecting them, right? So we wrote that even before. Currently, I would say, I think that we're going to get an inflation number which is higher than 1% this week, month-on-month terms. So we're getting close to 9. We might even trickle a little bit above 9 this month. That's a big number. And I think it's going to be extremely difficult to end this year with inflation being significantly below 8, which means we're looking at 7.5% to 8% for year end. And my concern is that regardless of where we are on Fed funds, whether we're at 3 or 3.25, it's not going to be enough. And the market currently is already pricing in rate cuts next year. That might just be way too soon. And that's the call, that we will actually see the Fed deliver getting closer to 4, but it will not spin on a dime and start cutting as soon as it hits 4, because it does need to get inflation out of the system. This happened once before in the 70s. They backed off too quickly, and then inflation came back.
This is a pretty bold call, Sonal, and I'm wondering where you think on the yield curve it is most mispriced that there will be cuts to those rates of the Fed next year. Where is it most mispriced that we're going to see inflation come down to a mere 5 or 6% versus what you're expecting of 8%?
So I'd say that if I look at the yield curve, if I look at what is priced in looking forward, we are seeing short-end rates pricing in rate cuts in the second half of next year. And is that to me is a mispricing. Now, the long end, it is interesting because I don't think that current levels are cheap. I think they're still rich. I think the long end does need to sell off more. Because the market is counting very much on the Fed being in a position to immediately cut rates once we get the slowdown in the economy, which clearly they're expecting and hoping for. That's only if inflation comes down as well. And if inflation doesn't come down, I don't think the Fed can cut rates,
so now you
even as the economy slows. Sorry.
You mentioned the 1970s. Long ago and far away, when I could shave once a week, I was given a private meeting with Sir John Templeton. That began a relationship over decades. And he told me then, pre-Volcker, that there would be a shortage of bonds. Essentially, folks, John Templeton called the Great Moderation. Other people did as well. But boy, that was a lonely call. Is the Great Moderation over? So now, can you were a Morningstar Fixed Income Manager of the Year. Can you say finally we've broken through the trend of the Great Moderation?
I think that the Great Moderation happened at a time when governments and central banks were not coming off 15 years of various forms of QE from central banks, and for governments, at least 3 or 4 years of massively expansionary fiscal policy. So do I think that shortage of bonds is history? Eventually, it will come back again. But I think for the next 3 to 5 years, I don't see a shortage of bonds.
Sonal, just quickly, I need to squeeze this in. We've got about 30 seconds with you. What's the big market call for you? I've heard the big Fed call, the big inflation call. What's the big market call?
The big market call is much more volatility coming forward. I've heard in 2 weeks' time, we had treasuries, the deepest, apparently most liquid market in the world, rally 60 basis points. In 2 days' time, we had them sell off another 20 or 25 basis points. These types of moves are not done. So I'm not ready to make that call to say jump into risk assets. I think it's way too soon.